Maybe you've been thinking about investing for a while now because you heard it from other people, or you read the headlines in the news, or watched YouTube videos like this one. And it got you hooked and you also want to start investing, but you don't know how. Well, if you're new at this, it can seem a little complicated and overwhelming. So in this video, I will give you an overview of how to start investing and maybe get a little deeper into the topic further down the line. So who's this video for? Actually, anyone with an income. This can be a teenager with pocket money, a student with some side money, or an adult with a regular income. By the way, it doesn't matter if you already have some money saved or not. We will also talk about that later. What this video is not about. I will not give you specific investment advice. I will not say buy share X or buy share Y, because I'm not a financial advisor. I took some business classes at uni, but none of them had anything to do with my financial knowledge now. I'm investing since about 5 years and I have a 6-figure amount invested by now. So I just want to share with you what I learned on the way. Right, so we will do this in 4 parts. Number 1, know the basics. We'll talk about some important terms, why we should invest, and some investment strategies. Number 2, strategize in 5 steps. Analyze, set a rate, secure, set an asset allocation, and set up a strategy. Number 3, automate, set up accounts, set up recurring investments, and track your investments. And number 4, some important principles and your next action steps to get you started. Feel free to skip to any part in the video that most interests you. One section that you shouldn't skip is the important principle part. So if you have a short attention span, please go there now. On the way through this video, we will answer questions like, when should I invest? How much should I invest? Is investing risky? And some common types of investments. Alright, let's start with number 1, know the basics. Important terms are money, but you already know what that is. Then asset. Assets are basically things that produce a positive economic value in the future, or at least they promise to do so. In some cases, you also earn money while you own them. Assets can be shares. With a share, you practically own a little part of a company, and you can own shares of a single company, like single shares. You also could buy funds, which is shares bundled together into one financial product. Another asset are bonds. This is where you lend money to the state or to another company. It's like you're acting as a bank. And for lending that money, you get paid a certain amount of interest rates. Other assets are real estate, commodities like gold, silver, oil, all kinds of raw materials. Cash is also considered an asset. And assets can also be physical objects like art, cars, jewelries, and some clothes. Careful with physical objects though. The return on the investment there is the least predictable. And then investment. What actually is an investment? An investment is nothing else than to put your money into assets. And we do so because of the promise to get more out of it in the future than we put in now in the present. Is an investment risky? Well, yes, it is. Because there are only 2 things certain in life: death and taxes. And as a matter of fact, you want it to be. And that brings us to the next important term, probably the most important term, the risk-return-tradeoff. It's that for making the risk of losing all our money, we get rewarded. And the greater the risk, the greater the potential reward, but also the greater the risk of losing everything. And that's very important to understand. If someone offers you like a 20% return per year without any risk, there's something wrong. Fortunately, there are 2 ways we can reduce the risk while still having quite a good reward. The first way is diversification. Now, diversifying means, for example, not buying shares of a single company, but diversify over different companies. It can also mean diversify over different sectors. For example, not only buy shares from tech companies, but also in other sectors like financial, agriculture, or health. We can also diversify over different countries. For example, not only the US, but also countries in Europe, countries in Africa, countries in Asia, or countries in South America. And we can diversify over different assets. So for example, not only buy shares, but also keep other assets like real estate, cash, commodities, or bonds. This diversifying over different assets is also called asset allocation. It's basically how you distribute your money over different kinds of asset in your personal portfolio. Keep that one in mind, we'll come back to it later. A good way to diversify shares is by choosing an index. An index is a bucket of shares that represents a certain market. There are a couple of companies that release those indices. For example, the Dow Jones is an index that represents the 30 biggest companies of the US market. The S&P 500 is an index that represents the 500 biggest companies of the US market. The MSCI All Country World Index represents the whole world market. So does, for example, the FTSE All World, which actually contains over 9,300 companies all over the world. So to diversify shares, we can buy a fund. We've already talked about this. A fund is like different shares bundled together. There are several types of funds. Two are important for us. One type is the mutual fund. A mutual fund is an actively managed fund, which means that there is a fund manager, an actual person, who decides which shares to buy into the fund and which not, or which to sell. Now, the thing with these mutual funds is there have been studies that actually over 80% of them do not outperform the market they represent. That means that if you compare the performance of the fund with the performance of an index, the fund's actually worse. And even the ones that did outperform the market could not do that for a period longer than 5 years. But because there is this fund manager with his staff, a mutual fund is quite expensive because they have to get paid. They can cost up to 1.5% a year. And this may not seem like a big number to you right now, but over a long period of time and the amount of money invested getting bigger and bigger, this actually adds up to quite a lot of money. So the alternative to this mutual fund is an index fund. An index fund simply buys the shares that's in the index, and the index already exists. And this all happens passively, so there doesn't have to be a fund manager. You know, it's like automated processes with computers that buy the shares in according to the index. And the costs for an index fund are accordingly lower. Most of the time they're in the range from 0.2 to maybe 0.5%. My personal opinion is that an index fund is the best way to start investing. They are also called ETF, which is short for exchange traded fund. One more thing though, because ETFs are very popular at the moment, there are thousands of products of different ETFs. Of course, not all of them are as diversified as we wish them to be for our portfolio. So for example, you might find an ETF for the big tech companies of the US, but then we miss the diversification over different countries and also over different sectors. So it's important to pick a well-diversified index or ETF. The second way to reduce the risk of investing by still keeping a good reward is the time horizon. So the important thing for private investors like us, who don't have the millions or billions already in the bank, it's important to invest over a long period of time, because in short term the market is really volatile, which means that it goes up and down and up and down. But over a long period of time, and by that I mean at least 5 years, rather 10 or 20 or 30 years, it's almost impossible to lose money. If one was invested in a world index for longer than 15 years, starting I think like in the 1940s, there wouldn't have been a single time that this person would have lost money if invested for longer than 15 years. Of course, we never can predict the future, but I think a look into history also helps. And I think the first share was traded in like 1400 something in the Netherlands. And just to look at what happened since then, like 2 world wars, countless crises, countless wars, and we still have a growing world economy. So for me personally, this unpredictable, we don't know what happens in the future kind of risk is not relevant to me. My personal future, on the other hand, with knowing that I'm working towards my financial independence, very relevant. Alright, another important aspect of this time horizon thing is the compound interest. Compound interest means exponential growth. This is particularly difficult because the human brain is not wired to understand exponential growth. That's why most of the time we underestimate it. And the thing is that in the start, when you begin, there's a long time that nothing's actually gonna happen. But over a longer period of time, the amount of money invested just takes off. Alright, this was a long section to assets, investment, risk-return trade-off, mutual and index funds, diversification, asset allocation, time horizon, and compound interest. Now, why should we invest in the first place? This introduces another term, which you might have already heard of. It's inflation. Inflation means that your money loses value over time. So the $1,000 you earn now will not be able to buy you the same things in 10 years' time than they could now. So what you eventually want to do is invest your money so that it grows over time. Other reasons for saving and investing your money now could be that you want to be independent from your pension or add something to it. Or maybe at some point earlier you want to get independent from a job that pays you. But that being said, saving and investing is not only for your future self, because you're learning new things about finances now. You're getting control over your financial situation now. You build security with money on the side now. And with all of those things, getting a good feeling about yourself now. Alright, let's talk about investment strategies, and by that I mean investment strategies for shares. So there are a lot of different investment strategies out there. They depend on the work you put in, either you yourself or also someone else. That can be an active approach versus a passive approach. You know, active for yourself means you pick a stock, you watch how it goes, and you actively decide, and then you have to watch them all the time. Passive can mean you buy something and then you let it rest for the next couple of years. Active and passive can also mean the funds. So we already talked about the mutual funds with an active approach and the index funds with a passive approach. Investment strategies can also regard the kind of shares. We won't get much into that, but for example, there are growth versus value shares, there are large cap versus small cap shares, and the investment strategy can also regard the time you plan to invest in the asset. So for example, a buy and hold, where we buy something now or continuously buy something now to hold it over a long period of time. Or for example, day trading, where we try to use the volatility of the market, the ups and downs every day, to buy at a low price and sell at a high price and then earn on the capital gain. I absolutely don't recommend this, because especially private investors lose like over 90% of the time. This active investing approach means that you are stock picking, which means that you pick single shares from different companies, and you do market timing, which means you pick a specific time to when to buy them. But this active investing approach requires a lot of time from you, a lot of time and a lot of knowledge. I mean, you also can do it without the knowledge, but then it's even more probable that you lose money instead of gaining it. With a passive investing, you don't actually want to perform better than the market. You want to perform exactly as the market or win with the market. And there is also dividend strategies or income investments, where you try to pick stocks that pay an especially high dividend. The three most important factors for us private investors are asset allocation, cost of investments, and time invested. So these three things promise a relatively high reward combined with a relatively low risk, meaning diversify your assets, keep the costs of these investments low, and invest as long as possible. That brings us to section 2, strategize. Okay, first time here is analyzing, which means you need to know your numbers. I already made a video about that, which is linked here somewhere. But basically you take a look at your income and your expenditure. And if you subtract your expenditure from your income, the sum here should be positive or at least zero at the end of the month. If it's not, that means you're spending more than you earn. Then it's important to evaluate your expenditure and look where you can cut down. The second step is to set a savings rate every month. You can either choose a percentage, which makes sense when your income changes every month, or you can just set a fixed sum. If you are a completely beginner, I would recommend a fixed sum. And it doesn't matter how much it is. It doesn't matter if it's $1 or $10 or $100 or $1,000. The important thing is to start, and it'll get easier over time. And you set the savings rate no matter what came out in the income expenditure subtraction. So even if you're already overspending, you set a savings rate. Step 3 is secure. At this point, I would like for you to check your insurances, because before you start dabbling of investing your earned money into assets that bring you maybe a 7% return per year, but at the same time you, as your biggest source of income, because you have a job that pays your income, you need to be secured from unpredictable things that can financially ruin you. And I know it's not that pleasant to think about it. The things that should be insured is health, liability, and disability. Alright, so insurances is the first part of secure. The second part is to save at least 3 months of income or your average cost in cash to be able to pay something that unpredictably happens. Okay, and another important part in this secure section is debt. Now, if you have debt, it's a bit more complex, and it depends on the kinds of debt you have. And there are also different approaches. For example, you can try to pay off the debt as soon as possible, or you can choose a 50-50 approach, which means that from your savings rate, you take 50% to pay off the debt and the other 50% to really pay or invest. It also doesn't have to be 50-50, it can be any other kind of percentage that you feel comfortable with. And maybe you should make it dependent on the interest rates that you pay for your debt. For example, if you have a credit card debt with a 12% interest rate that you have to pay, it's definitely advisable to pay it off before you start investing. Because again, a 7% return on $100 doesn't make a lot of sense if you can have a 12% return if you pay off that debt. Alright, step 4, set an asset allocation. That means you decide the percentage that you put in different assets. For example, you can choose a 20% cash and 80% shares. That is the one I have at the moment. So if your savings rate is $100 per month, you put $20 in the cash and $80 in the shares department. But really you can choose any other asset allocation. Another example would be 30% cash, 30% real estate, 30% shares, and 10% commodities. Or another example would be to put 20% in cash, 30% in bonds, and 50% in shares. In this decision of the asset allocation, your risk behavior will be important. For example, if it gives you goosebumps when I say 80% shares, because you're thinking, oh my god, the market is like up and down and up and down, I can take it emotionally. Start with 10% shares and see how you feel about it. Or maybe put a higher amount in bonds, which are more secure, but also don't have that high of a return. And finally, step 5, set up an investment strategy for yourself, which means decide, do I want to invest actively or passively? As you know, I highly recommend the passive investing approach. You already know that I am a fan of buy and hold to guarantee the long time horizon, and of index funds because they're easy to buy and easy to sell. They are well diversified, a bit dependent on the one you'll pick, and they're cheap. You can also make it dependent on your investing rate. If you're investing, for example, $20 a month, then I wouldn't pick an active approach because with $20 a month, you cannot diversify from the start. Then if you also pick the buy and hold and index fund strategy, next you pick an index. Again, I would recommend to choose the index as big as possible, representing the whole world. I know the S&P 500 is very popular, and there's probably not gonna go much wrong with the S&P 500. Have in mind though that it's only one market, it's the US market, and there's like only 500 companies in it. So maybe you could think about also mixing a bit of Europe or a bit of emerging markets or whatever into the mix. And then you pick a product based on that index. Now, if you are in Europe, you can just go to justetf.com. There you have a good overview of all the ETFs, and you can also filter after indexes and regions and sectors and so on. If you're in the US or anywhere other in the world, you could, for example, go to Yahoo Finances. But either way, don't stress too much about the product you'll pick or the share or the ETF, because studies have shown that your asset allocation is actually more important than which individual product it'll be in the end. Also, we haven't talked about retirement accounts yet, because it's very different for different countries. For example, in the USA, there's the Roth IRA and the 401k, and in the UK, there's the ISA and the LISA, but those are all very country specific, so maybe research if things like this are available in your country. When is actually a good time to invest? Yesterday, or maybe even better, 10 years ago. There is the saying that time in the market is better than timing the market, which basically means the sooner you start, the better, because right from the moment you invest, you let your money work for you, and the compound interest also starts. So of course, it's absolutely okay to take some time to set your investment strategy and do all the other stuff we talked about. But then once you did this, don't procrastinate, don't wait too long, just start. How much should I invest? Well, like we already talked about, start with whatever possible, even if it's $1, because you could start at $1 a month and you'll notice, oh, that's not that hard. And then it'll be $1 every 2 weeks, and $1 every week, and $1 every day. And soon you'll notice that you don't even miss it. Part 3, automate. If you are like me and you have a job and or you want to spend time with your family and your friends, and you don't want to invest too much time in this investing thing, we want to automate as much as possible. Here's how we do that. In order to invest our money into shares or ETFs, we need a broker. Now, the easiest thing, not necessarily the cheapest, would be to go to the bank where you already have a bank account. Because most of the time, a bank has also the opportunity to invest in the stock market. The alternative would be to pick an online broker. Those most of the time are very easy to handle and very low in cost. If you use the broker from your current bank, you just set up a recurring order for the product that you chose. For example, an MSCI World ETF. You set it up once, and then your bank automatically will buy shares of this product every month for the amount of money you decided on. This is called placing an order. So for example, you place an order for $100 every month for an MSCI World ETF, and then the bank will automatically buy shares for $100 every month without you needing anything further to do. If you use a different broker than your bank, you make a recurring transfer from your bank to that broker, and you do the same placing the order thing. And that's it. The beautiful thing about this is you invest time once, like now, you watching this video, you analyzing your finances, you setting an asset allocation and a savings rate, and you pick a product. But once all of this is done, you just place the recurring order once, and then the rest happens automatically. I love this. Of course, if you already have some money saved that you want to invest, you can also do it with like one order with a bigger amount of money. But even in this case, you should set a savings rate every month, and I would also recommend to make the recurring order every month. Important principles. Never, especially when you're a beginner, invest money that you don't own. So never take on a loan to invest in the stock market, because like I said, the market in the short term is very volatile, so it goes up and down and up and down, and it's only in the long term that it's actually building up. So if to have to pay back your loan in a time when the market is down, you lose a lot of money. So just don't do it. Then you should only invest in things that you understand. I hope that this video helped you to understand shares and ETFs. So don't start with options, don't start with any other kinds of derivatives unless you researched it a bit and really know what you're doing. Because especially as a private investor, you can lose a lot of money. And don't invest money that you need in the next 5 years. So if you want to buy a house in 4 years, don't invest this money into the stock market, because in exact 4 years the market might be down. These were the most important principles. There are some other tips I'd like to give, but it's only my personal opinion. Besides those important principles, just have fun. Play around a little, get a sense of what it means to invest in the stock market. Do it with little amounts of money so it doesn't hurt you. Maybe, especially at the beginning, imagine, okay, I'm going like to the casino with friends and I'm putting this amount of money into it. And if I lost that money, it would still be comfortable for me. So choose what's comfortable for you, because one size doesn't fit all here. To sum it up, your next actions. Analyze your income and your expenditure and set a savings rate. From the savings rate, first you build up the 3 months of cash. Decide on your asset allocation. Maybe get further information about certain topics if you need to. For example, read books or watch other YouTube videos, make online courses. Then you pick a strategy, you pick a broker, you pick a product and set up a recurring order. If you've watched this far, congratulations! You made a very important step towards your financial education and also your financial independence. That's only if you take action, of course. Please know that no one is born as an investor. Everyone had to learn it at some point, even the great investors that you maybe have heard of. In the past years, it has become very easy for individuals, for us private investors, to take investing in our own hands, and we should totally use that to our advantage. So don't be afraid, start with little amounts, you will get more comfortable over time. If you have any questions or wish for more videos on that subject, feel free to comment down below. If you don't think you can save anything, you might be interested in this video here about bad money habits. Subscribe if you like, and I hopefully see you in the next video. Bye bye.